Picture this. It's 2008. I'm staring at my trading screen, watching my portfolio bleed red as the financial world collapses around me. My finger hovers over the sell button. Everything I'd built over 3 years of trading was disappearing in real time, but I didn't click sell. That single moment of restraint, when every fiber of my being screamed, "Get out now!" saved my trading career and taught me the most valuable lesson I've ever learned about markets. It wasn't about technical analysis, fundamental research, or having the fastest execution platform. It was about something far more powerful, yet completely invisible on any chart: patience. Today, I'm going to share with you the psychological framework that transformed me from an emotional, reactive trader into someone who could sit calmly while others panicked. If you've ever felt the market was testing your sanity, if you've made trades you immediately regretted, or if you wonder how professional traders stay composed during chaos, this video will change everything. Stay until the end, because I'll reveal the specific moment when this mindset shift clicked for me and how you can experience that same transformation. Chapter 1: My Early Trading Disasters. Let me take you back to my early trading days when I was my own worst enemy. I started trading in 2005, convinced I had it all figured out. I'd devoured every trading book, mastered every technical indicator, and believed that success was just about being faster and smarter than everyone else. I was catastrophically wrong. My first year was a masterclass in emotional trading disasters. I'd wake up before market open, adrenaline pumping, ready to catch every move. The moment I saw green candles, FOMO kicked in, and I'd chase momentum. When positions moved against me, I'd double down, convinced the market would eventually prove me right. I remember one particular trade in Apple, back in 2006. The stock was forming what I thought was a perfect breakout pattern. Instead of waiting for confirmation, I jumped in early, afraid I'd miss the move. Apple immediately reversed, and rather than taking my planned 2% stop loss, I held on, telling myself it was just a temporary pullback. That temporary pullback cost me 15% of my account. But the real damage wasn't financial, it was psychological. I started questioning every decision, second-guessing my analysis, and worst of all, I began trading to recover losses rather than following my system. This is where most traders fail. They treat the market like a video game, where quick reflexes and constant action equal success. But I learned the hard way that the market rewards the exact opposite behavior. Chapter 2: The 2008 Crisis, My Defining Moment. Then came 2008, the year that separated real traders from pretenders. I'd spent 2 years working on my discipline, developing better risk management, and most importantly, learning to be patient. But nothing prepares you for a genuine market crisis. On September 15th, when Lehman Brothers collapsed, I watched my screens light up with panic selling. Every financial news channel was broadcasting doom. My phone buzzed constantly with messages from friends asking if they should sell everything. The fear was palpable, infectious. I had positions in several quality companies that I'd researched thoroughly. My technical analysis suggested they were oversold, but fundamentally, these were strong businesses. Everything in my body told me to sell, to preserve what capital I could. But then I remembered something Warren Buffett said. The stock market is a voting machine in the short run, but a weighing machine in the long run. I forced myself to step back and ask, has anything changed about these companies fundamentally, or is this just panic? The answer was clear. This was pure emotion driving prices, not logic. So I did something that felt completely unnatural. I waited. While everyone else was selling, I sat on my hands. Not because I was brave, but because my system told me to wait for better entry points, not to panic exit quality positions. That decision to remain patient during maximum fear taught me more about trading psychology than years of studying charts ever could. Chapter 3: The Anatomy of Market Patience. After surviving 2008, I became obsessed with understanding what separates patient traders from reactive ones. I started documenting every emotional trigger I experienced and developed what I now call the patience protocol. Here's what I discovered. Patience in trading isn't about sitting quietly and hoping. It's an active mental state with three critical components. First, preparation during calm markets. When markets are quiet, most traders get bored and force trades just to feel active. I learned to use these periods differently. I'd spend hours reviewing my trading journal, identifying patterns in my behavior, and refining my entry criteria. This preparation meant that when opportunities arose, I wasn't scrambling to analyze. I was ready. Second, recognition of emotional triggers. I started tracking not just my trades, but my emotional state during trading decisions. I noticed patterns. I'd get impatient after 3 consecutive small losses, or I'd rush entries when I saw other traders posting profits on social media. By recognizing these triggers, I could pause and ask, am I about to trade my system or my emotions? Hey. Third, trust in process over outcomes. This was the hardest lesson. I had to accept that individual trades might fail, but my overall process would succeed if I remained consistent. Every time I felt the urge to deviate from my plan, I'd remind myself, my edge comes from consistency, not from any single trade. Let me share a specific example. In early 2009, I was watching Goldman Sachs form a beautiful ascending triangle pattern. Every day it would test resistance and fall back. For 3 weeks, I watched this same pattern repeat. The old me would have jumped in after the second test, afraid of missing the breakout. But I waited. I trusted my system that required 3 confirmed tests before entry. On the 4th test, Goldman finally broke out convincingly, and I entered with full confidence. That trade returned 40% over the following months. Not because I was lucky, but because I was patient. Chapter 4. The Hidden Psychology of Winning Traders. Through my journey, I've noticed that successful traders share a peculiar trait. They appear almost bored during their biggest wins. While amateur traders are jumping up and down over small gains, professionals are calmly monitoring positions that make them fortunes. This isn't because they don't care about money, it's because they've trained themselves to respond rather than react. Let me explain the difference. Reacting is emotional and immediate. You see a big red candle and immediately think, I need to sell. You hear about a hot stock and instantly want to buy. Reacting feels urgent and necessary in the moment. Responding is thoughtful and deliberate. You see that same red candle and think, let me check if this changes my thesis. Does this invalidate my stop-loss level? What does my system say about this scenario? I learned to build response time into my trading through what I call the 60-second rule. Whenever I felt a strong urge to act immediately, I forced myself to wait 60 seconds and ask 3 questions. Is this emotion or analysis driving this decision? Does this align with my predetermined plan? Am I trading to make money or to feel active? These 60 seconds saved me from countless mistakes. More importantly, they trained my brain to default to thoughtful response rather than emotional reaction. I remember a day in 2012 when the market gapped down on European debt concerns. My portfolio was showing significant unrealized losses. Every instinct screamed to sell before things got worse. But I applied my 60-second rule and realized this was exactly the kind of emotional moment where patient traders gained edge. Instead of selling, I reviewed my positions objectively. Most were still above my stop levels, and the fundamental thesis remained intact. I held my positions and actually added to one that had become dramatically oversold. That disaster day ended up being one of my most profitable weeks of the year. Chapter 5. The Compound Effect of Patient Trading. Here's something fascinating I discovered. Patience in trading has a compound effect that goes far beyond individual trades. When you consistently demonstrate patience, several powerful things happen. Your strike rate improves. By waiting for high probability setups instead of forcing trades, your win rate naturally increases. I tracked my statistics over 5 years and found that my patient entries had a 68% success rate compared to just 42% for impulsive trades. Your risk-reward ratio expands. Patient traders enter at better prices and exit at better levels because they're not driven by urgency. My average winning trade now returns 2.8 times my average loss, compared to 1.1 times when I was an impatient trader. Your emotional resilience grows. Each time you successfully wade through discomfort, you're training your brain that patience pays off. This creates a positive feedback loop where patience becomes easier with each successful application. Your capital preservation improves dramatically. Perhaps most importantly, patient trading keeps you out of terrible setups. I estimate that learning patience saved me from at least 200 bad trades in my career. Even if those trades averaged just a 3% loss, that's still 600% of account value preserved. But here's the real magic. When you combine improved entry timing, better risk management, and superior emotional control, the results aren't just additive, they're multiplicative. Let me show you with a real example from my own trading. In 2010, I identified a long-term trend in commodities, but knew I needed to wait for the right entry. For 4 months, I watched crude oil consolidate between $75.85, waiting for a clear breakout above resistance. The impatient me from 2005 would have jumped in dozens of times during this consolidation, getting whipsawed and frustrated. But the patient me waited. When oil finally broke above $85 with volume confirmation and held for 3 days, I entered with confidence. That single patient entry led to an 18-month position that returned over 180%. More importantly, because I'd waited for the perfect setup, I was comfortable holding through normal volatility that would have shaken me out of a poorly timed entry. Chapter 6. Building your patience muscle. Now you might be thinking, this sounds great, but how do I actually develop this patience when everything inside me wants to act immediately? I'm going to share the specific training regimen I developed to build what I call my patience muscle. Like any muscle, it needs consistent exercise to grow stronger. Exercise 1. The watch list practice. Every week, identify 5-10 stocks showing interesting patterns, but not quite ready for entry. Your job is simply to watch without trading. Document what you observe, note when you feel the urge to enter early, and track how the patterns develop. This trains your brain to observe without acting. I still do this exercise every week. Last month, I was watching Tesla form what looked like a bull flag. 3 times I felt the urge to enter early, but I stuck to my criteria requiring a volume breakout above $180. When it finally came, I was ready, and the position returned 23% in 2 weeks. Exercise 2. The delay protocol. For every trade setup you identify, force yourself to wait 24 hours before entering, unless it's a day trading setup. Use this time to verify your analysis, check your position sizing, and confirm the trade meets all your criteria. You'll be amazed how many perfect setups look less appealing after 24 hours of reflection. Exercise 3. The Anti-FOMO Journal. Every time you feel FOMO about a trade you didn't take, document it. Track how that trade would have performed if you had entered impulsively versus waiting for your signals. After 3 months, you'll have concrete evidence that patience improves outcomes. Exercise 4. Mindfulness integration. Before each trading session, spend 5 minutes in meditation focusing on your breathing. This isn't mystical. It's training your brain to find calm in chaos. When markets get volatile, you'll have a mental anchor to return to instead of getting swept up in emotion. Exercise 5. The success celebration. This might sound strange, but celebrate every time you successfully demonstrate patience, even if the trade opportunity passes. You're rewarding the behavior you want to reinforce. I keep a patience log and review it monthly to remind myself of all the disasters I avoided by waiting. The key is consistency. These exercises only work if you practice them regularly, even when markets are quiet. Think of it like physical fitness. You can't get in shape by exercising only when you feel motivated. Chapter 7. Advanced Patience Strategies. After years of refining my approach, I've developed some advanced strategies that might help accelerate your patience development. The scaling strategy. Instead of entering full positions immediately, I often scale into trades over several days or weeks. This satisfies my need to do something while maintaining patience for better prices. For example, if I'm planning a $10,000 position, I might enter with $2,000 initially, then add more as the trade proves itself. The opportunity cost framework. Every time I'm tempted to force a marginal trade, I ask, what opportunity might I miss by tying up capital here? This mental framework helps me realize that cash is a position too, and sometimes it's the best position to hold. The probability mapping technique. Before entering any trade, I assign probabilities to different outcomes and identify what would need to change for me to add to or exit the position. This pre-planning eliminates emotional decisions during live trading and makes it easier to wait for predetermined levels. The reverse psychology approach. I tell myself I'm looking for reasons not to take a trade rather than reasons to take it. This subtle shift makes me more selective and patient about entries. Only the strongest setups survive this filter. The portfolio context method. I never evaluate trades in isolation. I consider how each position fits within my overall portfolio construction. Sometimes a perfect individual setup gets passed over because it would create too much concentration risk or correlation with existing positions. These advanced strategies aren't about making trading more complicated. They're about creating systematic approaches that naturally promote patience. Chapter 8. My greatest trading lesson. Let me share the moment when all these lessons crystallized for me. It was March 2020, during the COVID crash. In just 4 weeks, the market had fallen 35% from its highs. Every financial media outlet was proclaiming the end of the bull market. I had significant cash reserves, built up through patient trading over the previous year. As prices collapsed, I felt enormous pressure to do something. Friends were asking if they should sell everything. The financial media was predicting further crashes. My own positions were down substantially. But instead of panicking or rushing to deploy all my cash, I created a systematic plan. I would invest 10% of my reserves every time the S&P 500 fell another 5%. This plan required incredible patience as I watched potential opportunities every single day while deploying capital slowly. The market bottomed in late March, and my patient, systematic approach meant I was buying near the lows while others were selling in panic. More importantly, by having a plan and sticking to it, I avoided the emotional roller coaster that destroyed so many traders during that period. That experience taught me the ultimate lesson about trading psychology. The market rewards you not for being right, but for being patient while being right. There's a huge difference. The positions I accumulated during that patient accumulation phase became some of the most profitable trades of my career. But the real victory wasn't financial, it was psychological. I had proven to myself that I could remain calm and systematic even during maximum market stress. Chapter 9. Your Trading Transformation. Here's what I want you to understand. Developing patience in trading isn't just about making more money. It's about becoming the type of person who can remain calm under pressure, who makes decisions based on logic rather than emotion, and who trusts their process even when everything around them is chaos. These skills don't just make you a better trader, they make you better at everything. The patience you develop in markets will help you in relationships, career decisions, and major life choices. You're not just learning to trade better, you're learning to live better. I look back at that young, impulsive trader from 2005, and I feel compassion for him. He was so eager to succeed, so convinced that more action meant better results. He had to learn the hard way that, in trading as in life, sometimes the most powerful action is no action at all. The transformation from reactive to responsive trader isn't just possible, it's inevitable if you commit to the process. Every time you choose patience over impulse, you're building the mindset that separates professionals from amateurs. Your trading career isn't about the trades you make, it's about the trader you become. And the trader you become is entirely within your control. If this video helped you understand the psychology behind successful trading, hit that like button and subscribe for more insights from the trenches. Share your own patience victories in the comments. I read every single one. Remember, the market will always be there tomorrow. Your capital might not be if you don't learn patience today.